Well, I think the BOJ is caught between two things. First of all, is the fact that the Fed is clearly signaling interest rates are not going to go down like the market believed even 24 hours ago. So the BOJ has to look at the possibility that the yen will be much weaker. And they don't want the yen to be that much weaker. That's one side. On the other side, if they had raised rates and Donald Trump comes in spewing tariffs all over the place, hitting Japan's China business, which then goes to the US, and hitting Japan also, then next month you'd be looking at the need to cut rates, or maybe the month afterwards. So obviously they want to be consistent. And I think they chose the path which they signaled beforehand and which is not a surprise. So I really think if you go back to what the Fed said and what Japan said, I actually think we are looking at a world in which interest rates are flat. They don't go down, and they don't feed hope in equity markets anymore, and that the next move, big move, in the second half of next year will probably be increases, and they'll start in the US because of the effect of tariffs on inflation.
But I don't think it's fair, because I'm looking at, David, the chart of the yen over the last 3 months. It's lost 8%.
Yeah.
8%. That's a big move for the currency.
Yeah.
It's right now reacting as well negatively to the rate decision of keeping rates unchanged. It seems like for a major central bank like the BOJ, they're being held hostage by external factors, external risks. Agreed, the US is a very important export market for them. But they're really being constrained by international rate policy, fiscal policy, trade policy, then their own domestic factors, where obviously imported inflation is going to be a problem. I mean, if you look at the rate at which the currency is going.
Well, look, they can't let the currency go too far, because if they do, they will import the sort of inflation which they don't want to see. It's the sort of inflation where the consumers won't consume the increased wages they are getting, because the value of all the imports that they buy, which are important to them in a big way in Japan, will be increasing because the currency has been falling. They want to avoid that sort of inflation. Now, have they succeeded in doing that? Probably yes. I mean, they signaled well before the meeting what they were going to do. So, in fact, the 8% decline in the yen is effectively reflected in the policy decision that was taken, but it had been happening for a long time before. So I think the Bank of Japan is extremely influenced by international events because it has to ride that balancing act. The whole of its economic recovery program is based upon the idea that increased wages will end up in increased consumption. A vastly weaker currency would undermine that hypothesis.